Good morning, ladies and gentlemen. Well, throughout this period here, I told you to ignore risk off, but now the scores are starting to get negative enough, and I am not going to say to ignore this risk off. We are, I believe, in true risk off, and it's being led, as always, by the bonds and the yield curve. So this could last quite some time, certainly a period of a month or so. I would not ignore the warnings that are coming from the yield curve, and without further ado, let's have a look at the bonds. Let's start off with the yield curve, and here we are. I warned you that minus 16 was the big level, and that if that got broken, then we are in trouble. We're now going to, I believe, this minus 11.9, minus 12, whatever. It's not looking good because disinversions cause volatility, volatility causes degrossing. And here we have it. I think without a doubt we're going down to that level and quite possibly down to this minus 31 level. Do not short the short end. To me, this is a big warning. Why it's happening, who knows? A variety of reasons. We might find out that the economy is a lot weaker than anticipated, but the fact that we are breaking down finally these levels that have, I thought we would, and this is where I got short, and it's taken a long time, far longer than I thought, but I think now it's in trend. So if we look at then something like 530s, that's been even more significant. And where's it going? Well, apart from minus 52, where it could pause for a bit, I think this kind of level around minus 70 is entirely possible. And then it's just a steepening trade. I think it might take months, but I think it gets down to here, around minus 80. That is the natural progression of things, and when steepening occurs, you will find out later on why it's occurring, okay, what the fundamental drivers are. The price action is telling you steepening. I don't think there's any kind of argument anymore whether the yield curve is steepening or not. All those who thought that it wouldn't are just plain wrong. It's steepening. And while it might take a long time to get to those targets is what I expect to see eventually. And here we have the 2-year. Where's it going to stop? 369. Yes, volatility, up, down. Totally, resembling this. Why not? Okay, but what I am absolutely convinced of is that you will not see the level that we saw after the FOMC again. I.e., this kind of price action here on this day, this is when we broke the previous level, which is around the 432 area. I'm pretty convinced that we won't see 432 in twos for a very long time. I just cannot see the market going back to where it was before the FOMC. What does that mean to me? It just means that the risk reward of people who are trapped up here in the money markets, and there's $4 trillion of it trapped up here, is that whenever they see a bounce in the 2-year, the 3-year, the 4-year, the 5-year, they are going to come back and buy it. Because what is the risk? The risk is the reinvestment risk, that you will not be able to keep on reinvesting at 535, but you will have to buy the 2-year when it's down at 320. That is a lot of reinvestment risk. Therefore, every time that this goes back up a little bit, because some piece of hotter data comes out, there will be plenty of buyers. Whether you are long of the 2-year here and keep on being long, looking for levels which are much lower than this, okay, something probably around here, 250, is one thing. The But the most important thing is that you should not ever lose your position, your core position. Can it go back up to all this 426? Absolutely, it can. But so what? You should have a core position and then add much more at higher levels. The yield curve is disinverting for a reason, and therefore the twos, the threes, the fours, the fives will lead it. You do not get rid of positions in leading contract. Why would they lead? Well, there are many possible reasons. One is economic weakness. The second one is degrossing, which is not permanent. The economic weakness would be. But I definitely think that something is going on that we will find out much later on what it is and what the justification is. If it's economic weakness, what is the Fed going to do? If we now get unemployment spiking towards 4.7, 4.8, and the economy doesn't need to go into a technical recession, i.e. it could just stay at 1% growth in GDP, sort of close to zero. Well, if inflation is no longer a problem, then what's going to happen? The Fed is going to cut to nearly on top of inflation. And say inflation goes now down to 2.5, why would the Fed not cut down to 3% and still have 0.5 real Fed fund rates? Why? I just don't see the logic of assuming that they won't. There is too much danger in them not doing that. What can they possibly lose by cutting rates down towards real rates of 1% or sub 1%? As long as they keep them real, right, positive, I just don't see the danger. And that tells me that a much greater proportion of the move will be on the downside in rates rather than the upside. If we look at fives, I mean, it's all basically telling you that it's disinverting and that the short end will lead. I think fives will definitely trade around this 27 area, 327. And if fives go down to 327, why should twos not go to 3%? Okay, so to me, it's just ridiculous to argue that the Fed will not cut that far. It will. That's just all there is to it. If the economy is weak and we start getting some really weak economic data, especially from employment and especially from final sales, why would the Fed not cut to a level of around 3%, 275 for terminal rate? I just don't see the argument. Don't buy the 30s, don't buy the 10s. The yield curve is steepening. Ta-da, as they would say. 173 broken with impulsion and total decision. Now, whether it goes a little bit sideways before it hits this 152 level, how does it really matter? But this tells me that we are finally breaking this whole area here, and I would expect that eventually we would settle down at this level. So basically whatever this was on the bottom below, and you get towards 123. This tells you that German rates are going to go down less than US rates, and that tells me that everyone here is trapped. The dollar will remain weak, and US will lead the way down in yields. And this makes perfect sense to me, because if the US economy now weakens, what should lead? The US. And therefore, I'm absolutely convinced that this 152 and lower trades. I would not be surprised within 2-3 weeks to see this kind of level, 142, 143, and then we see. Tells me that for the next foreseeable future, let's call it 2-3 weeks, we have continued weakness in the bond market in terms of yields, right? Yields going down in the US, and a weak dollar. But why would a weak dollar happen, and why would the weakness in the bond markets happen? It has to be fundamental, and it has to something to do with some numbers that we will see going forward, i.e. weaker numbers for employment, weaker numbers for the real economy. So that's what I think is going to happen, and nothing is going to change my mind apart from price action. Above 173 again, and I'm wrong, but look at this 200-day moving average. Even if it gets there, all it's saying is that not now. But I do believe that it's now. I don't think the market is willing to give anyone the benefit of the doubt now. The economy has been too strong for too long. I think that this kind of 152 level is the one that trades first. Let's have a look at Italy, Germany. That is beginning to break out as well, and I would have thought that it's going to stabilize somewhere around the 160 area. But the one that's interesting is Germany against France, and that is breaking down. While I don't think it's going to go a million miles just now, I think that this tells you that people are fleeing the periphery. Okay, both the Italy-Germany and the Germany-France is telling you that people are fleeing the periphery, and it's a risk-off move. When it's a risk-off move, you are going to go and buy the safest asset. The safest asset is Germany, and that is why you're getting these moves. Watch out for a break below here. I think a break below there is going to be very problematic, because then you're going to go down to these kind of levels, 140, and that's another 70 basis points. It's gonna be ugly if that happens. So I don't know. It's looking ugly for this spread, and I'm afraid that that just is another nail in the coffin for risk on. I don't think that this is being caused just by France alone, although it could be. It could be that the French are going to do something extremely silly with their budget or their politics, or who knows. But when this happens, it's, to me, a sign of general risk off and people just fleeing to the safest assets. And that has implication for equities, right? So I don't think that you should disregard this at the moment. I'm sure the ECB will try to fight it around here. I'm not telling you to trade this per se. I'm telling you what the mood music is, and it's one of risk off. I just want to make sure that you see that all curves are disinverting. It's not just the US. This is more or less a global phenomenon if you forget about Japan. So 2s, 5s, we have taken out, what's this, August to August, we've taken out 1 year worth of range. So you'd expect 55 to 35, 20 basis points lower than that, you would be expecting at least this kind of level, 14, so another 13 basis points. That's the kind of move that you're looking in disinversion for the 2s, 5s. 2s, 10s, you've taken out again, best part, of 1 year's worth of trading range. So you'd expect it to come down to somewhere around here, around -66, -6 to -12. That's the kind of thing you're looking for. 2s, 30s, you're taking out, over a year's worth of range, and you're looking for something like this kind of level, at least. I would have thought here, -37. That's the kind of thing that you are looking for in the shorter time frame of, let's call it 2-3 weeks, a month. That's the kind of moves you're looking for. any kind of bounce towards the resistance levels that I have marked here in all of these 2s 5s, 2s 10s, and 2s 30s, you put it back on. I think it's quite clear that having broken that 173, the dollar is toast. I don't think it's going to be big time toast, but it's definitely going lower. All these levels that I have marked, 102.82 is going to trade, and I think on the weeklies really 101.92 is very likely to trade in the next couple of weeks. Eventually, I expect these levels, these lower levels around par 70, par 80 to trade. I don't think that there's much danger of the dollar going higher. In euro effects, what does that mean? That really means that I am looking for these kind of levels again. I think these stops around 109.80 are going to get taken out soon, and that is going to propel us to this kind of range, 110.40 all the way up to 104.70, and that is where it's going to stop for a bit. Euro USD higher, DXY lower, and that matches the break of 172, 173 in the 10s, and it just continues. I just see no reason to be bullish the dollar at the moment. The other thing that has to worry anyone who likes equities and risk on at the moment is this DBC chart. Commodities are now exactly where they opened the year. Okay, this is 2024, and I've been saying forever this 2175 level is absolutely critical. If in the next couple of weeks they start breaking down towards this 250 area and then down towards this kind of area below 1950, what does that indicate? Well, it indicates oil must be weak, right? Oil must be weak for that to happen because that contract is so much oil. So oil is making basically new lows for the year, and it's below 70. Copper, all the other industrial metals are also making new lows. How can the economy be strong? I mean, how? I just don't get it. And then how is inflation going to reaccelerate or even not moderate? And it's a question of how much. I mean, I have no idea. But if all input prices are going down, why would inflation not moderate? Okay, so we have then a Fed which is faced with employment going down. It doesn't know how fast, okay? It just doesn't. Prices of commodities going down, which is deflationary. I just can't see that they're not going to do a 50, right? And I can't see that they're not going to do a panic. And if all these prices are going lower, to me, it makes sense that the yield curve steepens and that we find out, I don't know, in a month's time that something blew up. I have no idea what, because you always find out much later when the price action is actually at the bottom. So, no, it's not time to sell twos. It's not time to fight the primary trend of disinversion, because when it starts happening, I've been telling you, as soon as it happens, you get risk off, you get volatility, you get degrossing. And that's happening where? It's happening, being confirmed by every market. So I really would not fight this. Gold. Okay, this is gold TLT. I think it trades the 200-day moving average. And then we have gold tip, which is a long way from its moving average. Now, what would make sense to me, and I've been wrong, so don't listen, is that this ratio should come down. I mean, why would you not prefer tips in a deflationary environment to gold? You know, it just doesn't make any sense to me. Why not take whatever gold does plus 2%? It just does not make sense to me. End of story. I've been wrong all this while, and nothing is going to persuade me that I'm not going to be right in the long term, well, apart from price action, of course. But I just prefer tips to gold. That does not mean that I don't think that gold eventually goes up. I just think it should go up less than tips. And if tips are going up less than TLT, that means that gold should be roughly stable. So let's have a look at gold. And that is what it's basically doing. It's not impulsive anymore, right? This was impulsive. This is not impulsive. This is up, down, and in fact it closes unchanged. So I think that, yes, will it trade above 2480? For sure, okay, for sure. But it's not going to be nearly as impulsive as the bond market. To me, the trade is to put it into short-term tips because those should do better. They just should. If the curve is disinverting, that means the 2s to 5s area are the impulsive ones, the 30s are the least impulsive, and therefore, if I'm looking for gold against TLT to come down a few percentage points, I must be looking for gold tip to come down as well, probably break this 2 area and trade around here and fill all these gaps from the beginning of the year. That would make sense to me. That can happen without gold going down at all, okay? So I'm not bearish gold. I'm just not as bullish of it for very, very simple, cogent reasons. Let's start the equity overview with the VIX, because this one really surprised me. It traded nearly the 3011 level. I mean, and these lines have been here forever, okay? People who've been following me for 8 years know that they've been there for 8 years. I really don't know why volatility is going up so much. Volatility is telling you again to be very careful. Now, I told you earlier that, and I've been saying for weeks, that when the curve disinverts, you get volatility. And yes, we're getting the volatility. What I don't understand is why we're getting so much volatility when the moves in the yield curve are so small. I think it has to do with the positioning, the short positioning of people in options, and basically they're just being stopped out at ridiculously high levels. Now, if we are now entering risk off, I can quite understand why volatility is going to go and trade these 3011s again, and then, possibly even up to 40. I can understand it. Why it happened on Friday, I don't know. I think it's probably to do with positioning, as I said. I can't come up with another reason because the move on Friday was not that big, and therefore I think it has to do with the positioning of people. But what is clear to me is that we're going out of a lower volatility regime into a higher volatility regime, and that can only mean risk off, okay? And everything I've looked at, from commodities to the way that gold is trading against tips, to the way that the yield curve is trading, the dollar is trading, everything tells me that we're going into risk off, which basically means a higher volatility regime. So I would expect the higher volatility regime to be somewhere between this 1750 up to 3010 level. So that is where I would expect the action to be. And all the other markets, this is Europe, the stocks have broken down the significant levels and they just gapped and kept going. 4850 was such an important level. What happens now? I guess we support around this 4550 area. And here we have 4580 as my important level on the monthlies. So that is the kind of area that I think that we will trade very, very quickly, and then we probably trade 44.30. That seems to be the kind of thing that's going to happen before you get a very, very strong bounce, and then we come back down again. It's definite risk off because every single market is now really, really breaking the 200-day moving average and gapping below. I guess there were lots of stops below the 200-day moving average, and that's what we got. Where is support? Here, 33,125 is the first support. But if you look at the monthlies, having taken out this range, I expect this whole move from 36.8 to 42 something to be reflected to the downside. So I'm now looking for levels which are actually lower than where we started, potentially where we started the year. That kind of level, sort of 33 and then down to 30,005. So actually a negative performance for the year on the Nikkei, and who would have thought that? But we're in risk off. These things are going to be fast and furious. Where would I buy it? I'd certainly buy it if I saw it Monday, Tuesday, Wednesday at this kind of 33,150, I would dare buy it for a quick flip. But, it's risk off. I probably would prefer to wait for a bounce to sell it, but a small, long at 33,125, I don't think is going to kill you. Right, let's have a look at all time frames here. What I don't like is that, on the monthly chart we're making lower highs, but, it's not that important. I'm not that, I don't think it's that much of a problem because it'll be resolved with time. But what is a bit of a problem is that we've got a lower high here on the weeklies on the MACD, and that tends to be not good. Okay, so let's have a look where the first support might be, and I think it's quite easy to enlarge this and show you that the first support is likely to be here, which is 52.50, and the second support is likely to be here at 51.95. Those are the first support levels on the weekly chart that I can see. Here we have the 195-minute chart, and that actually is at its 200-period average support. I don't think that is going to hold for very long. It might hold for a day or so, who knows. But really, you're looking at this 51.80 level as the first support, and then you're looking for these gaps here to get filled all the way down to 50.72. This price action here absolutely confirms and mirrors the price action of the yield curve, right? I mean, it just does. And let's have a look at what that action was. 2s10s made a bottom here around the 25th, 26th, and then proceeded to rally, and this market stood still and finally rallied, and then it broke down with the 2s10s. If the 2s10s keeps on going, I expect this to keep going. That's all there is to it, and I expect these levels that I've just talked about to trade. If you're trading NQ, it's also pretty clear to me that we are going to fill this gap, which is around the 200-day moving average. It seems that this kind of break of this kind of range has to be reflected exactly to the downside. So 18.5 to 18.7, that's 700 or 800 points, and that takes you down to this gap. That seems to me the first objective. It's all in risk off. I don't think there's that much to think about. One last word about risk. This is ITOT over government. to me, this is now getting bearish. Could we see a little bit of retracement? Yeah, sure. But to me, this is looking to break these levels, break the 200-day moving average, stop everyone out, and fill a few gaps. I don't think it goes lower than these kind of levels, but that is, that's a long way. That's another 7-8%. So I'm not going to fight this. I might fight it at these levels, but that is what what this chart is saying, that you could easily get that kind of percentage move down, and that would correspond probably with something like another 3, 4, 5% in equities. That is what is on the cards before we can say that we're going to get some relief. I've changed all the levels. The primary trend is breaking. Disinversion causes volatility. We're a new volatility regime. We should be in risk off. We should be very, very careful about sizing, and we should be playing the equities to the downside, the bonds to the upside, and especially the short end. I don't care what anybody says. The Fed can react a lot faster than the market can, than a lot of people can understand. And risk off means that the very short end just does stupid things. So don't get short of 2 years. You might really, really regret it. All these other markets are looking ugly, as is the dollar. I'm not bullish on gold simply because I think there are much, much better alternatives in an environment where DBC is getting killed, if it does get killed, right? And if it does trade below that very, very important 2175 level, then people will start talking about deflation. Okay, so, and that is more fuel for the very, very short end and the disinversion, which causes even more volatility, which causes even more degrossing. Basically, we are not in a good position for risk on. So don't get caught too long of equities, hedge, be careful. Thank you very much indeed, and tweet you tomorrow.